Folks, it is rough out there. Today was one of the best Mondays we've seen in quite a while, and it's mostly because, well, the market was closed today. And I know there's a lot of doom and gloom out there, and rightfully so. The macro situation is pretty damn bad. Even on this channel, a lot of folks have said, Charlie, I wish you would stop with the heartwarming content. It's just too optimistic. Charlie, your content makes my stomach flutter with positivity. It's like little butterflies of just bullishness. And obviously you've seen the compounding of pain play out month after month after month, and things just seem to get more and more negative. But blanket negativity without strategy to take advantage of that negativity is pretty useless, isn't it? It's like, sure, yeah, maybe this does warrant crying in your room all day, but that doesn't really help anybody. So with that in mind, in this video I've put together 5 catalysts that will mark a turnaround in the stock market and will indicate that we've not only bottomed, but are now on our way to a new all-time high. I highly recommend writing each of these down and posting them somewhere on a wall so that you don't forget, because as we progress through this crisis, each of these will be hit. So the first catalyst to look for are energy prices peaking and heading down. Not to be crude, but let's talk crude oil specifically. If you haven't noticed, crude oil prices right now are rivaling all-time history for the top spot, almost getting to June '08 highs. Crude oil prices have a history of skyrocketing just before a recession or during a recession, and then peaking before the recession ends. This time should be no different. Expensive crude oil prices mark one of the clearest signs of economic decline. Consumers and businesses only have so much money that they can spend in an economy. The more of that available money pie is spent on energy, the less they have for other things. Crude oil and energy overall is the lifeblood of pretty much every activity in the economy. High energy prices can cause consumers to cut back on spending elsewhere quite a bit. That can cause businesses to see huge decreases in business activity and have to cut back on staff, which then creates less and less consumers that have jobs and can pay for goods and services in an economy. Meanwhile, even the most essential businesses see their profit margins get cut dramatically as energy costs eat up more and more of their overall margin. At a certain point, and we've already started getting past that point, but energy costs get so expensive that businesses have no choice but to pass on those costs to consumers, who then have to pay higher and higher prices for their everyday goods and services on top of their own energy usage, which means more and more of their overall pie of purchasing power is spent on just their essentials. The skyrocketing energy costs that we're seeing right now are kind of like a value add tax that taxes businesses and consumers at every part of the supply chain and reduces the profitability of literally everything, and in some cases makes it negative. And when it's negative, companies have no choice but to raise prices dramatically or go out of business. We need energy prices to peak to really see a lot of confidence in the overall market. And the worst part is that the Fed right now is doing this little game where it's acting like it can get inflation down meaningfully without getting energy costs down and without causing a recession. History suggests that it just can't do that, and a hike isn't going to lower the price of energy. While the Fed raises rates, it's just going to destroy demand for consumer goods, which are already seeing huge profit margin cuts because of rising energy costs in other segments. If energy prices continue going up and are on a continuous overall uptrend, markets are going to continue to be increasingly upset that the Fed is going to have to nuke the entire economy to bring down prices on a segment that it has little control over. As long as that's the case, markets will not be happy. So the first catalyst for markets to start being optimistic again are energy prices peaking and establishing a downtrend from that peak. And there's 2 levels to that, right? There's temporary pullbacks that suggest a change of trend, and then there's the real pullback. A temporary pullback could be a 3-4 week pullback. A real pullback could be a 2-3 month pullback. The temporary pullbacks will in all likelihood cause short-term rallies in the market, but the real long-term pullback is what you really need to trust the actual uptrend. How do we know that energy prices are peaking? Well, number 1, proof of concept in the chart, month over month over month. Number 2, a actual commitment to produce more energy in not just the United States, but also in our allied countries like in Europe. If Europe all of a sudden has less demand on the global supply chain, then all of a sudden globally benchmark prices go down and our prices go down as well. We could talk all day about how well-intentioned but poorly implemented energy policies in Europe and in North America have created this dynamic where in order to save the environment, we're sending tons and tons of money to countries that quite frankly don't give a hoot about the environment and are also using the money to fund geopolitical interests that are opposite ours. The point is oil production needs to actually go up and the trend needs to actually show month over month decreases in the price. This will ripple through every energy segment and you will see most prices go down and the market will love that. The second catalyst to look for is the aligning of the lunar cycle. If you go to moon.nasa.gov, you can see the current moon phase as of today. We are in what's called the third or last quarter, which is a half moon. Now, there's real studies dating back to stock market data since 1950. This data shows a strong correlation between market performance and underperformance and the lunar cycle. The green line, the bullish period, designates periods that start about 3 days after a full moon. The red periods designate periods that start about 3 days after a new moon. Going back to the current moon phase, again, we are in the third and last quarter. Next part of the cycle is a waning crescent, or in France, they like to say a waning croissant. And then we'll have a new moon. Unfortunately, again, new moon periods historically tend to be a bad period of time for the stock market, designating a red period historically. So we need to go through almost an entire cycle again to get back to a period of time where the stock market historically performs well. We need to go through the cycle as fast as possible to get to that full moon. Jokes aside though, seriously, this data on the correlation of the stock market and the lunar cycle is actually true. This is why you got to be real careful about how you draw conclusions on data and different correlative factors. Okay, the real second catalyst are food commodity prices. The more consumers spend on food, the less they have to spend elsewhere. I don't need to tell you that food prices are out of control. You look at these prices on the BLS's latest CPI report. Cereals and bakery products are up 11.6% year over year. Meats, poultry, fish, and eggs are up 14.2% year over year. Dairy and related products up 11.8% year over year. Fruits and vegetables up 8.2% year over year. Non-alcoholic beverages and beverage materials up 12%. Other food at home up 12.6%, and the average for the food category is up 10.1% year over year. This is another segment that the Fed, quite frankly, doesn't have much of an impact on with rate hikes. And there's reasons to believe it's going to get far worse before it gets better. The main reason is because of fertilizer shortages. You look at the price of urea, which is a commonly used fertilizer. The green line shows 2021 prices, the red shows 2022 prices. The ingredients in fertilizer had been skyrocketing all last year and have been accelerated by the Ukraine war this year. Prices right now are at about $1,000 a ton, despite the 5-year average being around $400 a ton at this time of year. Similar uptrend in prices with other fertilizers. So why is fertilizer getting so expensive? Well, this is actually connected quite a bit to energy and connected commodities. Coal and natural gas are used to create urea fertilizer. Ammonia and sulfur are used to create DAP fertilizer. Each of those commodities or minerals are skyrocketing dramatically, creating a massive shortage in fertilizer, which in turn creates a shortage in the ability to produce food, which in turn causes prices to go up. The reason you're seeing continued warnings all over financial media of, quote, food supply shortages is quite simply because you have a huge shortage in the ability to produce fertilizer and the ability to buy it. But what isn't in short supply is the ability of you to get up to 10 free stocks plus a share of Lucid when you sign up with our sponsor down below. In the stock market, what separates the amateurs from the elite? Is it caffeine? Is it a fancy suit? Is it organic produce? Well, those things may help a bit, but what really separates the best from the rest is ultimately the ability to do proper risk versus reward analysis on the spot, gain rapid insights, and of course, form and stick to effective strategies. But in order to do those things, you need the right tools behind you. Moomoo helps you monitor market movements, perform deep technical analysis, quickly screen for stocks that meet your criteria, and also provides a community where traders can exchange ideas amongst one another. Moomoo also offers crucial features like fast fills, AI monitors, AI price predictions, and of course, candlestick screening searches. Moomoo is a one-stop trading app that makes it easy for traders to do everything they need to gain that extra edge on the market. If you are looking to step your trading game up to the next level, give Moomoo a look. And we've arranged where if you sign up and use our link down below, you can get up to 10 free stocks, plus an exclusive free Lucid stock. We never want to leave free money on the table, folks, so make sure to check them out below. Thank you, Moomoo, for sponsoring this video. Now back to the content. But okay, plug aside, the reason that you're seeing continued warnings around the world of food supply shortages is because fertilizer and the alternatives are becoming in shorter and shorter supply. Part of that are commodity prices that make up the necessary ingredients to make this fertilizer being in short supply. But there's also the compromising of direct fertilizer imports from Russia, Ukraine, and Belarus, which made up to 10 to 40% of global supply of these three major types of fertilizers in 2020. So you have these major markets that produced fertilizer all of a sudden being compromised dramatically and not being able to export to the rest of the world. Now, the reason this is important is everybody says, oh, the Fed is going to fix these prices. Well, no, if the Fed raises rates to 20% tomorrow, how does that fix our fertilizer shortage problem? It doesn't. You'd have to be a doofus to think it does. And by extension, the price of food just won't go down until the fertilizer costs are going to go down, and they show no sign of stopping. In fact, the upcoming months should see them heating up quite a bit as energy prices have stayed steady and food prices lag energy prices. If anything, raising rates is going to make it more expensive for businesses to take out debt to be able to invest in better food infrastructure and healthier supply chains. Things have gotten so bad that Business Insider and many other outlets are running articles today suggesting that human urine might have to be a real alternative to chemical fertilizer shortages. Better stay hydrated, folks, because Uncle Sam is going to need you. So the second catalyst here are food prices coming down, which is going to stem from the increased production and availability of fertilizer. This catalyst will lag energy by a few months. So by the time that energy prices are peaking and a lot of these other commodities start peaking, well, within the next couple of months, you're going to start seeing food prices peak as well as that ripples through the supply chain. Number 3, let's get out of commodities and talk valuation. We've been selling off for a while, but a bullish catalyst for the market will be when the market has hit ridiculously low and obvious deal levels of forward PE ratios. There are a lot of people with a lot of money who have rushed out of equities and other investments and are increasingly rushing out of them and are going into the US dollar. But they don't want to stay in the US dollar for long because that is a losing strategy. The US dollar is always going to lose money over the long run. Nobody wants to stay in the melting USD for longer than they have to. And I know that many people have been critical of the Fed and its success at bringing inflation down. But even I have to give credit where credit is due. The Fed has managed to meaningfully stop the inflating of stock market prices that we had seen overall since the '08 recovery. People say, oh, the Fed has had no success at taming inflation this year. Wrong. The S&P 500 is down 20% year to date. The NASDAQ down 30% year to date. That's not just taming inflation, that's deflation. The point is, though, that people with money have the burden of figuring out where to park it in order to first retain their purchasing power over the long run and also, of course, ideally make gains on that. And while costs of goods and services continue going up for everyday consumers, the cost of actual long-run return-generating assets have been going down consistently, which means that for wealthy people or anybody that has extra cash that they're not going to use on day-to-day items, well, that money's actually getting more valuable, not less. It's going to go farther in equity markets, not count for less. And so there's going to be a point in time where people start buying dramatically. And that, in my view, is going to be where it's so obvious historically. And what I would look at are those forward PEs. You look at the forward PE ratio for the S&P 500, it's dropped dramatically from 23 to 15.4. But historically, even in the last 2 decades, there were substantially better periods of time to buy in based on forward PE ratios. If you believe we are heading for an economic collapse, 15.4 is still too pricey in the short to medium term. At a certain point, though, and on the current trend trajectory, it'll become obvious that valuations are a steal based on how low PE ratios are. And people are going to say, ooh, now's the time to buy. That's probably somewhere around 10 if things get bad enough, below 10. But at a certain point, people prefer putting their money in cheap companies versus just keeping it in USD. Now, tread carefully with this. Of course, forward PE ratios are based on forward projections on earnings, and a lot of analysts have not yet adjusted their forward earnings rates yet, which means that even right now, the price to expected earnings looks a little bit better than it actually is. But as the narrative plays out over the next quarter or two, you're going to see that become a lot less of a problem. Fourth catalyst, inflation and unemployment numbers. We talked about a market survey that showed that 55% of economists would consider clear and convincing evidence of progress on inflation to be small monthly gains in core inflation. That's a pretty low bar. It's only asking for core inflation, which means minus food and energy, to decelerate, not even go into deflation, but just decelerate and only have monthly gains gains that are small. So when we actually hit that, which should be far before when the actual problem is solved, well, that's going to be a preliminary catalyst for the market to start bottoming out. But the main catalyst is going to be how the Fed actually reacts to this. As you know, right now, the Fed is playing a game of nuking demand in nearly every segment in order to hopefully bring down inflation, of which is largely commodity driven, which of course the Fed has no impact on. Raising rates doesn't help solve the supply chain. But at some point you'd have to expect that either the Fed causes a recession with their aggressive tightening, or inflation causes a recession with pricing consumers out of everyday goods and services. But at some point, a combination of tighter interest rates destroying economic activity, an easing of commodity prices, and an overall restriction of spending money on anything that isn't necessary for survival should create this environment where inflation is going down and going down steadily, and the economy is also in a bit of a mess with unemployment numbers picking up quite a bit and a lot of the growth in the economy looking very, very bad. When that point has been reached, the Fed is going to stop focusing on inflation and then focus on unemployment numbers, at which case it's going to pause its tightening course and probably, based on the last 100 years of Fed policy, go ahead and reverse to lowering interest rates again. Fed themselves have admitted that they see unemployment picking up into 2024 and an overall economic slowdown to be inevitable to some extent. Now, their projections in the past have been overly optimistic. Likely this one is as well, and that little employment that they're projecting is probably going to be significantly worse. All of these things will predate a Fed turn back to easing of monetary policy, which then creates one of the best, most conducive environments for the market to rally. It is possible that you head into this environment where the economy is doing terrible and inflation is still hot, but is a little bit cooler. At that case, you better bet that the Fed is going to prioritize keeping people employed versus keeping inflation towards their 2% target. They're going to say, who cares if inflation's at 4%? As long as people are working, we'd rather prioritize that. Right now, lots of people are working and the labor market's tight, so they're like, okay, well, we want to focus on pricing pressures, but at the end of the day, their main focus is employment. They'd rather have everybody employed and pricing pressures going to the moon than no one employed and pricing pressures in deflation mode. Finally, and the last catalyst that I believe will make the market really skyrocket is the reversal of earnings expectations to the upside. Currently, company and CEO expectations and confidence have been downgraded substantially quarter over quarter after quarter. This last quarter was quite a doozy. Most companies were either reporting a slowdown or were reporting the next couple quarters to be very, very slow. At a certain point, you're going to go from bad guidance and a slowing down quarter over quarter to a complete plateau where numbers are terrible, but companies are starting to have more and more confidence in the future. This is probably going to be the very last catalyst to be hit. And at this point, valuations will have already bounced a little bit, but companies are going to start being very, very optimistic as a lot of these other prices have started coming down and profit margins are starting to go up again and consumers are starting to be more confident again and make a little bit more money while inflation is stagnating or at least at a lower level. At this point, that's when I would expect the market to really start going parabolic. My guess is that in order for this catalyst to be hit, probably going to need at least a few meetings of FOMC policy reversals, overall inflation going down over a multi-quarter basis, and commodity prices dropping substantially. I believe that the main policy trajectory that we're on right now is not meant to make the cycle go really, really fast, but instead drag out the cycle as long as possible so the numbers don't look really, really bad all at once. If policymakers really wanted to go through all these stages as fast as possible, they would be increasing domestic production by quite a lot. They'd be raising interest rates by a lot more and a lot faster. They would be creating deals to lower taxes on companies and give tax credits to companies instead of penalizing them and continuing to add more and more red tape. And they would cut back aggressively on government spending, not just year over year when comparing to the comps of when we were deep in a pandemic, but actually on an overall trend line in order to make sure that we're not continuously sparking artificial demand on a supply chain that just can't afford to have the demand right now. But unfortunately, policymakers seem to not have much of an interest in doing those things. So it's probably true that this cycle is going to play out over a long period of time, but that eventually it will play out. It's just going to be slowed down by the way that policymakers are handling things. But anyways, folks, that caps off the video. I hope you have a good rest of your day. See you in the next one. Make sure to hit that like button below and also subscribe for more videos on the stock market and everything that's going on.